Welcome to The Explainer. Today, we are going to completely demystify real estate investing and prove that true, lasting wealth often starts with just a single, incredibly boring property. It is so easy to get totally overwhelmed by all those get-rich-quick social media gurus shouting about buying 100 doors by the time you're 30. So let's just strip all of that noise away right now and look at the actual foundational math behind everyday financial independence.
Let's start with a guy named Marcus. He was a Memphis electrician. Totally normal guy. Zero real estate experience. Back in 2011, he bought this totally unsexy $87,000 duplex. We're talking a cracked driveway, a kitchen stuck in the 1970s, literally the exact kind of place most people would just scroll right past online. But he house-hacked his way to savings by living in one side and renting out the other. His tenant ended up paying about 70% of his mortgage. Fast forward to 2018, just 7 years later, and he quit his job as a multimillionaire with a net worth over $2 million. He didn't have a massive trust fund. He started with one very unremarkable duplex.
Now, you might be thinking, okay, Marcus just got lucky. But his story really isn't some wild outlier. We tend to think most rental homes are owned by massive, faceless corporations. But, incredibly, 42% of all landlords in the United States own just one single rental property. Think about that for a second. That is a massive chunk of the market. Just regular people quietly building wealth in the background, one door at a time.
To help you hit that crucial first milestone, we're going to follow this roadmap today. First, the power of one property. Second, the 2026 housing market. Third, strategies to get started. Fourth, real estate math 101. And finally, funding and landlording fundamentals.
Section 1. The power of one property. Why boring is beautiful.
So we already know about that 42% who own just one property. But when you add in the 33% who own between 2 and 4 properties, you realize that 75%, 3/4 of all U.S. landlords, operate with 4 units or fewer. Small, steady beginnings are absolutely the norm here. And you know what the raw data doesn't tell you? It's the education you get from that very first unit. Getting that midnight phone call for a burst pipe, figuring out how to deal with contractors, it gives you the necessary, if maybe slightly painful, scar tissue you need to survive the long game.
Take Dana, for example. She's an Ohio teacher who is making just $41,000 a year, and her story perfectly captures the psychological power of just holding on to one asset. She inherited a modest $62,000 home, deep-cleaned the place, and rented it out for $750 a month instead of taking the quick cash and selling it. That tiny stream of cash flow gave her the breathing room to fix her credit, and she leveraged it into a 4-property portfolio that eventually surpassed her teaching salary entirely. She sums it up perfectly saying, "I didn't build this because I was smart or brave. I built it because my grandma gave me one house and I was just stubborn enough not to sell it."
Section 2. The 2026 housing market. A favorable backdrop.
So it's really important to understand the environment you're actually stepping into. 2026 is not some frenzied panic gold rush. Instead, we're looking at a steady, recovering market. Affordability is slowly improving, thanks to mortgage rates dropping back down near 6%. Plus, housing supply is actively increasing, hitting about 1.1 million units available. And this is huge. There are new executive limits placed on those mega investors, capping institutional buyers at a maximum of 100 single-family units. That opens up some incredible breathing room for everyday buyers like us. Throw in a forecasted 5% overall market growth, and you've got a highly stable backdrop for making your first move.
Section 3. Strategies to get started. Choosing your weapon. Okay, so how do you actually want to do this? You can go highly active or completely passive. On the active side, we've got house hacking. Like Marcus, you buy a duplex, live in one side, rent the other. The absolute best part of this, using an FHA loan lets you get in with a super low 3.5% down payment. It's high involvement, sure, but the leverage is incredible. Now, on the exact opposite end of the spectrum, you have REITs, real estate investment trusts. This is the ultimate passive strategy. You invest in a collection of properties exactly the same way you'd buy stocks in a brokerage account. And by law, they actually have to pay out 90% of their taxable income as dividends. So the real question is, do you want to be fixing toilets for maximum leverage or totally hands-off collecting dividends?
Section 4. Real Estate Math 101. De-jargoning the formulas.
All right, if you're going to play the game, you absolutely must understand the numbers. Let's start with the cap rate or capitalization rate. This is your ultimate equalizer. Basically, think of it as a tool that tells you exactly what your return would be if you were to buy the property entirely in cash today. You calculate it simply by dividing your net operating income by the property's current market value. Why does this matter so much? Because it lets you look at a duplex in Ohio and a retail space in Texas and objectively compare their underlying return profiles, completely ignoring whatever the asking price happens to be.
But wait, to figure out that cap rate, you first need to lock down your net operating income, or NOI. It's actually a super simple concept. It's just your expected rental income minus the day-to-day costs of running the building, things like property taxes, maintenance, insurance, and vacancy buffers. But notice a really key phrase here. This is calculated before taking debt service into account. Your mortgage payment is not part of your operating expenses. Understanding your pure, unleveraged NOI is basically checking the fundamental pulse of any rental property.
Let's actually put this into practice with a real example. Let's say you're looking at a retail property, and the tenants are on what's called a triple net lease, meaning they pay literally all the operating expenses. So your gross income is $240,000, and your expenses are zero. That makes your net operating income a clean $240,000. Now, if you've done your homework and you know the standard market cap rate for this area is 6%, you just divide that $240,000 NOI by 6%. And boom! The result is a rock-solid, completely objective property valuation of exactly $4 million. You don't have to guess if it's overpriced. The math just tells you what it's worth.
Section 5. Funding and Landlording Fundamentals. The Execution Checklist.
So, the elephant in the room. How do you actually fund that down payment? Well, if you already own a primary residence, tapping into a home equity line of credit, or a HELOC, is one of the most powerful ways to fund your new investment without draining your hard-earned savings. Generally, lenders will let you borrow up to an 85% loan-to-value ratio against your home. You just use that equity line to write the down payment check for the new rental, apply for the second mortgage on the new property, and close the deal. It is literally leveraging the asset you already have to acquire the asset you want.
Okay, you've got the keys. Now what? Following a strict checklist is what separates the amateurs from the pros, ensuring you operate smoothly from day one. Do not skip steps here. Prioritize safety by installing smoke and carbon monoxide alarms immediately. Protect your investment by running strict criminal and credit checks. Tenant screening is literally your first line of defense. Get a rock-solid legally binding lease, collect the full first month's rent and the security deposit before you ever hand over those keys. Change the locks. And whatever you do, never skip the move-in inspection. Properly documenting the state of the property on day one is exactly how you avoid messy deposit disputes down the line.
Look, the data and the stories all point to the exact same truth. A real estate empire doesn't start with a massive portfolio. It begins with one single, boring asset. It starts with a cracked driveway, an ugly duplex, or an inherited house you're just stubborn enough to hold on to. The education you're going to get from that very first door will compound faster than any interest rate out there. So, what is actually keeping you from finding your first property today?